Welcome to the Motor Carriers and Education Foundation in-depth review of coverages addressing the unique operations of a motor carrier. This session is omitted and excess and surplus lines. These webinars are not filed for state CE and it's a learning opportunity only. If you're seeking state CE or have any questions about this presentation, please send an email to trs@mcief.org. I want to welcome a true friend of mine, Erin O'Leary, out of Jacksonville, Florida. She's a longtime MGA and deals a lot with trucking, and I asked her to participate in this because she's also is very involved in the surplus lines not admitted market. Erin, welcome.
Thank you, Tommy, for the opportunity to participate. Our agency has served the independent agent communities in the Southeast for over 68 years. Shelley Middlebrooks and O'Leary specializes in underwriting transportation and casualty lines. Commercial transportation has remained my underwriting focus, as well as internal training and development. In 2017, I served as president for the Florida Surplus Lines Association and initiated a campaign to promote the excess and surplus lines industry in Florida. We hope this presentation will enlighten you on the E&S industry.
Clearly, you know about surplus lines, obviously, because that you've been involved in this, and Erin, and a lot of the people I'm teaching earlier on, particularly the newer people involved in this, really don't understand that. So I appreciate you taking time today to explain this to the newbies in this industry to get a better understanding about the advantages of the surplus lines not admitted market, as well as some of the things that they need to be aware of when they get involved in that market. Let's go forward then. So we're going to talk about admitted insurance, and we're going to talk about the guarantee fund, and we're also going to talk about the type of insurers who are involved in this. And it's excess and surplus lines insurance, E&S. You hear this market, and they're in a minute you'll see that's through a third-party agency with a special license. And in this marketplace, there'll be an eligible list of who can participate, meaning insurance carriers. Plus, we're going to have a discussion about the premium tax and the fees, which is different than the admitted carrier, and the data that's involved here. The concern that you would have as a retail agent in this is the rates and the forms could be different than in an admitted market. We'll talk about that. And again, we're going to end up looking at the main focus for our Motor Carriers Insurance Education Foundation, and that's providing insurance to interstate for-hire motor carriers, and talk about how the surplus lines E&S markets get involved in that particular market. So the admitted market. This is a admitted market. It's licensed to sell insurance in a state, which means each one deals with the state itself, meets the criteria of the state. They have to file their rates and their coverage forms with the state, either by using, later we'll talk about ISO to do it on their behalf, and or their own proprietary forms. But the state polices them to make sure that these forms and these rates are applied. The purpose here is to protect the citizens of that state, so there's uniformity and insurance carriers don't take advantages of the public, as well as, and unfortunately we find the state also wants to make sure it's an adequate premium so the insurance company is insolvent. So they monitor these things. They also monitor the financial results of the insurance carriers, and if they get in trouble, that has to be done on an annual basis with reports. It's called the conventional statements, a big yellow book, and to make sure that they are solvent, and then would put warning the public if they become insolvent or some problems with the financial part of it. And they also have ability that if any insurance company abuses them, does not provide the service, keeps denying claims, does not honor what they should honor, including things like risk management stuff, the state steps in. So the state provides consumer protection by administering also the guarantee fund to protect the policy holder in the event the insurance carrier defaults or becomes insolvent. And the guarantee fund becomes a big question here because it applies to admitted markets only, not to the surplus lines, not to the not admitted market. We'll talk a little more about that and the consequence of that as we move forward here when we get to the surplus lines and not admitted market. The state guarantee fund responds when an admitted carrier becomes insolvent and has any open claims, meaning claims cannot be paid because there's no dollars there to do it, because the insurance carrier has been put in receivership and has been liquidated, or insolvent. I had experience in this many years ago. Erin, were you even born when Andrew hit Florida?
I was around.
Yeah, but you were
I was
still
young.
It's been a long time ago. If you remember, Andrew is a hurricane that went through Miami many years ago. And in that hurricane, there were 23 insurance companies who went under in Florida because they just weren't prepared. That was the first major hurricane since the 1960s here. And so what the Guarantee Fund does is that it only has a maximum in states about $300,000. Some states vary a little bit, but that's the maximum. The maximum says this is all we'll pay, plus that includes any kind of return premium and things like that. And that doesn't go far in commercial auto when we have $750 or $1 million worth of limits and the liability there. So that becomes a problem too. But the other thing is how the Guarantee Fund is funded. It's not sitting there. It's not the government's going to pay for it out of taxes. This is in Department of Insurance. This is not a tax entity. And so what happens is that they charge so much for everybody writing that line of insurance. In the case of Andrew, it was property coverage. If an auto liability carrier went down, it would be auto liability. And there would be a percentage added to the policy to fund the Guarantee Fund or to fund the insurance companies who went under. And what happened to me in the case I had, and the reason I brought up Andrew, is that I had some roof damage, less than $10,000. But what happens with these funds is you pay it out, and if there's no more funds, you have to wait till the next year. And Erin, I waited 2 years to get my money just because of having to refund. And so what happens is, and this is one of the problems with admitted companies, is now since their policy is subject to guarantee funds, if another insurance carrier went insolvent, what did that insurance carrier do? They took bad risks. They didn't charge enough money. Their performance made them insolvent, or they were fraudulent. Then every insurance company who did things right, who are still solvent in Florida, have to pay for those penalties. And that's a problem with admitted carriers. It's one of the concerns with admitted carriers in this marketplace. But the Guarantee Fund is a consideration you have, and later you're going to see as a surplus line is not admitted, that has to be noted to the insurance company. We're going to talk about better ways to check that out than just worrying about the guarantee funds. Erin, on this next thing here, we use these terms, and I find it's kind of unique to this marketplace. A domestic carrier is a carrier who's admitted in a state, that state. A foreign insurance company is not somebody over the pond. It's an insurance company who is admitted in the U.S. but not in that state. And an alien insurance company is someone who is not admitted in any state. Erin, do you want to say a little more about these things? Because these are weird terms as we get through things, particularly that alien insurance company. I mean, for you, would that be London? And Lloyd's of London would be an alien insurer?
That's a great example. The Lloyd's of London syndicates and Bermuda come to mind when I think of alien insurers.
Yeah, and they're not people that came out of Star Trek and those kind of things. That's the point we're making here. But you hear this term in this area. And the one other term here that we don't have you need to be aware of, later we're going to talk about where you export it. And when you talk about exporting it, it's taken out of the admitted market into a not admitted market. And so we'll move on now. Erin, this is your bailiwick. This is the stuff you're doing here, excess surplus lines, insurers. How about spending some time and this kind of gives us an overview here on this page, if you would, please, ma'am.
Thank you, Tommy. You might hear the excess and surplus lines market referred to as E&S, non-admitted, or unauthorized. All these terms refer to the surplus lines market. Surplus lines insurance promotes economic growth by offering a coverage solution for exposures that present higher risk or require larger limits. Think tourism and entertainment, construction, research, and innovation. Surplus lines writes risks that are distressed, unique, or high capacity, or require high limits. Some examples of surplus lines risks would be cyber liability. It's a unique risk that requires special forms and underwriting expertise. Excess automobile liability is a high limit risk. And when we think of a distressed risk, residential construction like tract homes would be an example. As Tommy mentioned, in the admitted market, rates and forms are filed with the state. In the E&S market, rates and forms are not filed with the state, which allows the market flexibility to respond quickly and creatively to emerging risks. Some new risks that we've seen enter the market have been private flood, drones, active shooter, and transportation network companies.
You missed one out there, cannabis. That's a new wavy thing here. That's a good example of one that we're dealing with every day with the rates and forms that people just have to, I don't like the word make it up, but they try to intuitively, let's do that deal, what the coverages are going to find and what the potential claims to collect the premium, because some of this stuff, particularly the cannabis and that, there's really, and you make the active shooters and all those things, they just don't have any history. So they've got to come up with a projection. That becomes something. But that's where an underwriter has a lot of discretion. And in those cases, Erin, I found that the better the retail agent gives the underwriter information concerning those particular areas, the better the underwriter can come with something that seems reasonable.
I agree. Oh, the last thing is we discussed the guarantee fund that applies to the admitted market. And while the E&S is not included in the guarantee fund, E&S insurers are obligated to meet stringent financial requirements to protect the consumer. For example, an admitted insurer in Texas is required to maintain only $5 million in net worth, while surplus lines carriers are required to maintain a minimum of $15 million in capital, and surplus lines insurers based outside the U.S. are required to maintain $45 million. Also, E&S focuses on risks that require high capacity or higher limits, which exceed the state's guarantee fund limit.
Yeah, that's an important part here. And by the way, for you who are listening, there is a guarantee fund for surplus lines in New Jersey. That's the only state that I'm aware of that has a guarantee fund for surplus lines in New Jersey. We mentioned two things. They have this, the policy tax and fees also apply, and that becomes something retail agents don't understand, because Erin, when you quote a price now, you say, here's the premium plus tax and fees. And so they think that if you write admitted market, they don't pay taxes. Guys, government always collects their money, right, Erin? They're going to get it from somebody. So the difference is who can pay the state the taxes. A admitted company can pay the taxes directly to the state. That's the premium tax, directly to the state, because they are admitted and deal with the state and license the state. Surplus lines carriers are not licensed by the state, are not admitted to the state, and then are unauthorized in the state, so they don't have ability to collect that taxes. So that's where they're going through a third party, and that's a surplus agent that we're going to talk about here. They also can have fees attached to it, and that would be also a requirement for the surplus lines market. Will do that. They'll have to do some function. By the way, for you agents, just understanding, you get no commission on the taxes and the fees, and sometimes that becomes a concern when we get through this. Erin, there's a couple things here. We hear about who's eligible to write on the surplus lines excess market. You give us some examples here. How about running through these for it, and how to get it eligible, meaning part of the eligibility is you as an agent, what you have to do to make sure the risk is eligible. So we got both the company who's eligible to write surplus lines and risk who are eligible to be exported into the surplus lines marketplace.
Yes. Each state department of insurance provides a list of coverage lines eligible for export. Prior to exporting a risk to the surplus lines market, state statutes may also require a diligent search to prove the admitted market is unable to write the risk. For example, in Florida, we require a diligent effort where 3 admitted markets have declined to write the risk before the risk can be exported into the surplus lines market. Also, before quoting a risk with surplus lines, the agent needs to confirm the insurer is eligible to place business in that state. The National Association of Insurance Commissioners maintains a list of eligible alien insurers, and Florida has 3 types of eligibility lists posted on the Office of Insurance Regulation website. Be sure to check your state department's website for a list of eligible insurers.
Again, this comes back to this alien word, but what we see in Florida here is the authorized insurer, those are the admitted companies. The Florida eligible insured would be the non-admitted companies that are listed here. And so that would be the terminology that you'd be involved in that part of it. And by the way, the states vary as far as this affidavit and protect the admitted market. When you say protect the admitted market, that's what we've used in terminology. Erin, I don't like that terminology, because really what the state's trying to do is say we're protecting the citizens of the state. Admitted carriers, we know the forms, we know the rates, and we have a guarantee fund. Non-admitted, we don't. And so we want to make sure it cannot be written on a admitted market who's gone through the exercise to be licensed, admitted, and understand the forms, and it has to be worthy to be exported into this non-admitted where the forms and rates can be different. This is what's there. And you have some concerns, which Florida is one of the ones that it requires more. Ohio is extremely protective. And somebody in Texas and Louisiana, in fact, Louisiana let anybody do about anything in those cases, not in those areas. So it depends on how far the state. So who's listening here when you have this, and this, a lot of this is going to be controlled, is it not, Erin, about going through the surplus lines agent, which we'll get to in a minute. You're the one in this, because you're in 2 or 3 different states. You make sure that when you deal at export, that the agent fills these forms out. Is this not something that you do as an agent to help them walk through this or provide these forms?
We do. It's part of the application process. We get audited either annually or every couple of years, depending on which state we're writing business in. And part of the audit is looking for the completion of these forms by the state.
So it's a dual situation. The retail agent has to do it because they got to find the admitted markets and all that to sign off. And in some cases about having to do the affidavit where the insured has to sign it and knows the surplus lines market. But at the same token, you as an agent, a surplus lines agent, would have a responsibility that your file is complete with these forms. So that's the thing. Erin, we got this surplus lines policy and fees and taxes. I talked about them a little earlier. How about going through exactly what this is? And again, who knows what a stamping office is? I thought you bought stamps at post offices.
Thank you, Tommy. You'll notice that policies placed in the E&S market have tax and fees applied. In Florida, statute allows for a reasonable policy fee to be charged by the filing surplus lines agent for each policy certified for export. The per policy fee must be itemized separately to the customer before purchase and enumerated in the policy. The fee charged by the filing surplus lines agent is taxable. The retail agent may also charge a fee. However, the fee charged by the retail agent will not be subject to surplus lines tax or itemized in the policy. The WSIA website provides a summary of all policy fee regulations per state. And as Tommy mentioned earlier, tax and fees are not.
I'm sorry, tell them what WSIA is. That's the wholesale agency, like the big I, right?
Correct.
Okay, that's the trade association, right?
As Tommy mentioned earlier, the tax and fees are non-commissionable.
What's a stamping office?
The stamping office monitors the activities and compliance standards of licensed surplus lines agents conducting business in the state, as well as eligible surplus lines insurers through compliance review and premium reconciliation programs. In Florida, the premium reconciliation program compares data submitted by the surplus lines agents with the data submitted by surplus lines insurers to ensure that all taxes and revenues have been submitted in accordance with state statutes.
So literally you send the stamping office a copy of the policy and stuff like that, and they literally put a stamp on it, or is that where that terminology comes from?
So the stamping office, we used to stamp the actual deck page of the policies, and we would send a copy of the deck page to the appropriate state department. Florida actually developed a technology system that we can now report online the taxes and fees, so they go by the name of a service office opposed to a stamping office.
So that's just an old terminology that we use. Like sometimes I see our truckers still using the terms ICC, right? That's just a terminology for something bigger than that. You did the next page to show us how the stamping office keeps track of these things and also how much premium is being exported to the surplus lines market. This is a good report, Erin, that you found here on page 13 that you're slide 13 that you're sharing with us. Just give me a little bit of overview of what this this U.S. map means.
This graph shows the surplus lines premium written in states that make the data publicly available. It also represents how vital the E&S market is in areas exposed to large catastrophe events. For example, Florida experiences hurricanes, New York's skyscrapers require high capacity limits, and California has earthquakes and wildfires.
This is a pretty good market. This is a lot of dollars here. In fact, I think on the next slide, you even give us some information about the non-life, meaning this would be the casualty. This would maybe be property and casualty, which would be the non-life stuff, about a little bit about the growth and stuff, and this is significant here. Tell us what why you found this was important enough to share with us.
Yeah, this graph, it shows that surplus lines represents on average 7% of the property casualty market in the U.S. Historically, we can see the surplus lines industry has maintained a lower loss ratio than the admitted market from 2013 to 2016. Then starting in late 2016, the loss ratio for E&S spiked due to the industry responding to large catastrophe events like Hurricane Harvey, Irma, and Maria.
But they do particularly, and one of the reasons here is that, of course, they were able to react immediately to some concerns about price and premium and keep it at that level without having the state approve those rates like you have to do in the admitted market. But this is showing how much this market is, and it's a very vital part of the whole delivery system. And retail agents need to be aware that this market's out there as a place to look for the risks that meet these kind of characteristics to be exported. One of the things we had talked about is the standard forms. And Erin, when I deal with the surplus lines market, this is what I like to make sure the retail agents understand the forms and rates here, because that's where they could become a problem. We'll talk a little more about that in a second, but most of the insurance companies have agreement with insurance service offices to represent them to the states. And the ISO develops forms and also collects statistical data from different insurers who are part of their program. And that data is by classification, meaning into an area, a zip code, or to a location area, and to something characteristics of the risk and the data close. They collect the data that says, here's how much premium that was collected from this classification for $100,000, and here's how many losses that have been reported within that classification, and they come up with a advisory rate or a loss cost rate. The reason they use the word loss cost is what they're saying is for this particular risk, this particular classification of a risk, this is how much money that you would charge that you should break even. And then the insurance companies add to that the commissions and the profit they want to have. And so this is what has to be filed with the state. And I get involved sometimes, Erin, as you know, with ISO, in fact, to rewrite some forms, the auto dealer form, the motor carriers form, and it's a process. And some states are very proprietary. Some states are harder to get them filed or not. In fact, Virginia is the worst state. I was doing a class for CIC in Virginia a number of years ago, and I made a comment because they were still using a very old policy when I was doing this, and I said the only difference in Virginia's policy is how pollution is done for auto liability. Unfortunately, in the audience, I had someone that was from the Department of Insurance raised her hand and said, we got 102 things differences in the policies. And then and the ridiculous part about Virginia, what they did is they moved to this newer policy form, but then they have a mandatory endorsement that brings all the coverage back to the old form. So this is what ISO has to go through. But what they're doing, and just so getting the bottom line, what they're doing in the admitted companies is to make sure that the forms and the rates meet the citizens' requirements, and that the citizens clearly know when one form is different than the other and those notifications. This is the important part here. The ISO, they look at court cases and new kind of exposures and risk. So they set policy wording, and a lot of the policy wording, because it's standardized, has been something you can refer to from one court to the other, because that court has interpreted the standard policy wording, where if it's not standard, you don't have the backup here. So the file forms include the recap of the difference between current forms and the past forms, meaning when they go to a new line of coverages, then they have to be required to write, here's where the differences are between what we were doing and what we're doing now. And so this is an important part here. I guess, Erin, when I'm talking about 15 is with the ISO developed forms, that's where the benchmarks, that's where the standard. And this is what most of the state licenses, the texts are based on, and this is the education retail agent. So when you're a retail agent, you need to understand, is this a standard ISO policy promulgated by ISO, and are these the loss cost based rates here? I think that's important. Anything else about that, Erin, that you find important, or is that sufficient?
I think that covers it.
Wow, what is this?
Let's look at a new emerging risk whose unique qualities will find some of its lines of business covered by ENS. Tommy, you mentioned yesterday that these trucks are on the highway today, and there was one carrying a load from Charlotte to Naples?
No, from Miami to Naples. In fact, I was sitting on a panel in San Francisco 3 years ago with a autonomous vehicle symposium, and on that panel there was somebody there who was actually running those trucks that way, because they were talking about the weather in South Florida. I said, how do you know South Florida? And of course, I'm sitting here in Fort Myers on that panel talking about the things you have here as far as the product liability and auto liability, how that's going to be there. So they're there if you read all that. This is where it's coming, and the autonomous vehicles is where there's no driver involved in it. We're not there yet, but it is being experimented, and a lot of industries there. The economics of this, just not having anything to do with admitted, not admitted, is you don't save a whole lot of money until you take the driver out. But once you take the driver out, you save about 50% of what it costs to operate a truck on a mileage basis. So this is where we're going in this area, and this is a great example where we have no statistics, no data, everything is different. We don't know where the court cases are going to come out and things like that. So Erin, you got a few things you need to worry about here, value and all. You want to talk a little bit about where you as a host surplus lines agent, or what you will look at that you would find in the AAS market to address this unique exposure?
Thank you. Yeah, so self-driving trucks, they're individually, it's a high-valued item that might exceed the admitted market's appetite to insure. Also, they have intricate technology systems like collision avoidance, electronic stability control, a rear and forward camera system placed throughout the tractor and trailer. So the cost to replace just these items for a minor fender bender are going to be expensive. It might be a typical tractor for a small loss could have been $2,000, but now when we start adding all this technology on the truck, that same accident might cost $15,000. And when a loss occurs, the cause of loss will determine if it was driver error or an operating system failure, which is unique. The autonomous vehicles will present a large liability exposure for the manufacturer who writes the software. For example, the software being placed in self-driving trucks will have rules to determine collision avoidance, deciding to hit an animal on the side of the road or swerve to hit another vehicle. There is also a threat of operating systems being a target for a cyber attack. Imagine a catastrophe that a platoon of trucks could cause if the operating systems were compromised with a virus. You may find that when rounding out the account, some coverages for your insured will be placed in the ENS market.
And the commercial auto, this is another place because this autonomous vehicles there's no history, so they can't file rate. Truck platooning, this is a unique thing. This is where one truck is following the other truck, and the distances are very, very close. The first truck, the rear truck is tracking the first truck, and they're kind of doing it in parallel. This is very prominent in Europe. It's not done here. In fact, in some states, Erin, that if you get that close, you've actually called reckless driving. So these are where we're also going to find a lot of the state laws are going to have to be changed to meet this requirement. But this is an example where you who are running for-hire interstate motor carriers will have to face within the future. I'm talking about within the next 3 or 4 years, some of your insurers are going to be getting more and more involved in this. And Erin, that's a great example of the use of surplus lines to meet this emerging markets, things that we don't understand yet about it. You also mentioned the high value one. This is offshore race boat, is it not? You want to talk about this? You talk about cargo. That's a unique cargo.
It is. It's an impressive looking boat. An example of a cargo risk in surplus lines could be writing a high value performance item like this boat valued at $1 million. There's unique exposures to loading and unloading with the tilt trailer, and the coverage forms may be manuscripted to cover losses like loss of use and income loss if the boat isn't delivered to the race in time.
So we're mentioning not only the liability and casualty, but things, and this is an example involving in trucking that has high value things for property. And that's why we wanted to bring beyond the truck. The cargo becomes a real important part here. And clearly, Erin, in this case, the shipper would put a lot of burden on the motor carrier to make sure they take care of it and there's enough coverage there. That becomes a situation. Those are great examples that you might find on a daily basis involving for-hire interstate motor carriers. Let's talk about the precautions I talked about earlier. Bottom line, read and understand your policies being offered. That's your responsibility as a retail agent. I have made a living. I learned about CIC. I learned about you had to read and understand the policies early on in my career. And I encourage you, if you're going to become a professional in this area, who are newbie in this area, you need to understand the policies you deliver. That's a contract that's a contract between the insurance carrier and the insured to pay for assets that are damaged, if there are property coverage, and or assets that could be taken away for liability coverage. And what that contract says is what the insurance company has to perform, and the duties that the insured has to keep the policy in place, like what's a covered auto. It's very important. So when providing insurance to motor carriers, the coverage forms could be different, again, between admitted and non-admitted. Physical damage is a great area. You got some that are written ISO, you got some that are written in the marine, you got some that's written non-admitted. Cargo's always different. Each policy could be different, so you got to read that. Work comp can be will be uniform, but every state's different. So when you deal with auto liability, general liability, cargo, you need to be aware of these kind of differences to be comfortable where you as an agent are delivering these policies. So let's talk about commercial auto in a minute in surplus lines. The state statute depends the limits that must be exported to a surplus lines if the line of business can be exported to the surplus lines. Erin, what did you mean by the state statute determines if the line of business can be exported to surplus lines for commercial auto?
So the state statute will determine whether or not commercial auto liability could be a line of business that could be placed in surplus lines.
And a lot of times I ask this in questions here because in a second we're going to tell you the importance of this for the 91X filing if you're insured as a hauling process goods interstate commerce. I ask people who determines if it can be written admitted or non-admitted, and everybody thinks about Department of Insurance. That's not Department of Insurance. It's a state Department of Motor Vehicles because they set what the minimum limits of the state's financial responsibility, how it can be admitted, either admitted or not admitted. That's the important part of it, because what we deal with in for-hire interstate truckers, if your insured has an MC number, if your insured has authority to haul processed goods in interstate commerce of others, then they must have a 91X filing. That's a certificate of insurance sent to the FMCSA, and that certificate of insurance sent to FMCSA must be provided by an admitted carrier in some state, not necessarily the state that you're writing the primary coverage in. And so that's the difference we have involved in that part. And I've always used an example here, Erin, and some people might not realize this. I think you do, obviously, is that Lloyd's of London is admitted in Kentucky and Illinois. So they can write primary insurance coverage in, say, Texas on a non-admitted basis, but still can make a 91X filing accepted by the federal FMCSA because it's admitted in some state. The reason the FMCSA put that in place to be admitted in some state is they didn't want to have to look at every insurer who is writing providing insurance to interstate for-hire motor carriers and making these filings. They're leaving that to some department of insurance. They don't care. They didn't care which department of insurance. It's any department of insurance will oversee these admitted markets. So they just wanted to make sure that when the 91X filing is made, then the filing is made by somebody who's admitted in the U.S. because it's overseen by Department of Insurance in the U.S. If you can write admitted and not admitted is determined by the Department of Motor Vehicles. And I think, Erin, we've got a list here of commercial auto liability that can be exported, not admitted. And I find in the two major states here are California and Texas. There's a lot of premium written in those two states, is there not?
There is.
And it's very common for them to written non-admitted. I see we got two asterisks in Florida. That's something recent. I'm sure you're dealing with that. Could you to explain why you got the two asterisks in Florida different than others?
Yeah, so Florida allows commercial auto to be placed in the surplus lines business if there is a federal filing, and M91X also part of that policy.
So, and part of this was, Erin, I found that because Florida rates were so high, they had to open it up to some. And again, they're going back to what we did on the previous page, is that Florida accepts it only people with 91Xs because now they know that policy that's being written by that insured, even on a non-admitted basis, is by an insurance company who's admitted in some state. So again, falling under some state regulatory oversight, the Department of Insurance in some state. So this is how it's tied in here. And so you'll find it very common in some of these states, particularly Texas and California, where it will be written on a non-admitted basis, but they still can make the 91X filing. So these are states, if you're aware of it here. And so commercial auto surplus lines, I find that on page 21, some examples, I'm sure you run in this all the time here, where you meet the minimum state requirements for admitted, but you don't do the additional, like Florida 300,000, you might write the 450 extra 3, or in some cases we have the hazardous marketplace where you can write the 1 million admitted on the state, but do 4 million of 4x of 1 for excess in a non-admitted market, again, to be more ability to get the right premium for it. On a daily basis, Erin, can you give us a little examples of how you run into this or where this comes across?
Yeah, a lot of times when we're writing a charter bus that's crossing state lines and it requires 5 million in limits, we will place 1 million in the admitted market and we'll place the 4x in the surplus lines market. And you can have a filing posted on each one of those policies that'll post in the FMCSA website.
And by the way, just a note, the 91X, the X is there to allow it to be layered. That's the significance of the X. There is some 91s out there that are not layered, which is just a quirk of the human, just the numbers that are involved here. Erin, you gave us on this next slide here, we're getting close to the end of this presentation, just your thoughts about what a retail agent needs to know about placing insurance in excess market. And give us an overview of where we are with this, the things we need to be not concerned about, but just aware of. I think that's a better word than concern. It's not a concern, it's just we need to make sure we do these things right as a retail agent.
First, we want to make sure the surplus lines agent and the retail agent have the proper license to place coverage in that state. We want to check the eligibility lists for that state to make sure the surplus lines carrier is eligible to write coverage in the state. And we also want to know what the state requirements for export are into the surplus lines market. For instance, is there a diligent effort requirement or a surplus lines disclosure notice? You'll also notice that there'll be different surplus lines tax and fees that apply per state. And as an agent, two of the most important things you want to know are, will the coverage form meet my insured's needs, and does a minimum policy premium apply?
Those last two are very important here. I want to look at this. Does the coverage form meet the insured's needs? It's two ways. Is there coverage there? And if there's any exclusions, and you need to compare the surplus lines wording in the policies, because a lot of times I find auto liability, Erin, and general liability, they probably start with the basic ISO forms, but they have a lot of proprietary endorsements. And that's where we want a list of all those endorsements. I assume that you're willing to provide a retail agent all those proprietary endorsements and the forms, are you not?
We do. A lot of things you want to look for might be like a driver warranty that could be included in the policy, and that might list certain things like the driver has to have 3 years of experience and no major violations. And if the driver doesn't meet those requirements, there might be a deductible that applies, or the loss could be excluded.
Or radius limitations, or I found one company that makes the payment, the defense within the limits, and how pollution is done. There's a whole lot of various things here. The other thing here about meeting insurance needs is you do need to check the financial stability of the insurance companies, and that is through the best rating in those areas. And so I think that's an important consideration also, Erin, that they need to be worried about is the insurance rating. And I think sometimes that can even cause an E&O problems, it not, because sometimes the retail E&O wants to make sure it's written with a carrier with a certain best rating.
That's right. Your agency aero and emissions policy has a minimum rating requirement. Any carrier whose AM Best or Demotech rating is below that requirement at the time coverage is bound can result in declinations of E&O claims resulting from insurer insolvency.
And this has nothing to do with admitted and not admitted, but since since the stamp that has to be on the policy tells the insured that this is not, there's no guarantee funds. As it was talked about earlier, I don't really rely on the guarantee funds. I want to make sure they're financially sound. So you need to verify and check those things. And they do not write surplus line because they're financially impaired. They write surplus lines and export and write these kind of coverages so they can be flexible enough to achieve the right premium for the right coverage. And this is the bottom line. The minimum premium policy, you need to worry about this as a retail agent. Is 25% relatively standard in those things, the minimum earned the day you bind it, Erin? Is that what you find in most cases?
That's what we typically see.
And what that means is if you bind it and Erin sends you a commitment and a binder is bound, then you're going to be obligated as a retail agent under your account current for 25% of that premium, even if the insurer doesn't pay you, and if they want to cancel it before that. That becomes a major consideration here that you need to be worried about. That's different than the standard market. I think what we're saying in all this, Erin, is that we as a retail agent trying to provide insurance to for-hire interstate motor carriers need to understand the for-hire motor carrier unique insurance needs. And then we need to find out what kind of policy meets those needs. There's not a right policy, there's not a wrong policy, as long as those policies meet the insured's exposures and provide the coverages that the insured knows about. Areas where you have no coverage, then I think we need to alert the insured where there could be some problems with coverage or how to get coverage. One example you just used, Erin, about a driver notification where coverage is dependent if the driver has been reported to the insurance company. Those are kind of things there. Erin, anything in closing you want to add?
Just like to reiterate that surplus lines, it's a vital market and it addresses unique, high capacity or distressed risks. And placing coverage in the non-admitted market, it's similar to placing coverage in your admitted market. However, there are nuances when exporting a policy to surplus lines. Each state has various rules and regulations. Be sure to check the proper stamping office, trade association, or Department of Insurance for the best guidance.
Thank you, Erin. Thank you for your time. And we hope that everybody got something out of this. It is an important consideration as you deal with for-hire interstate motor carriers to understand how the market can address the unique needs of your insured. And if you have any questions, please feel free to type them in the TRS at MCIEF.org, and we'll respond later. Erin, Thank you very much.
Thank you, Tommy.